This is a Yahoo Finance special, Reshaping the Market. It's a modern-day David versus Goliath, small investors versus Wall Street titans. Non-professional traders are upending the stock market in ways we've never seen before.
I've learned a lot from the other members of the community in the past 7 months, and I believe they are some of the smartest people in the market. I believe that they should be on Wall Street, not the people on there currently.
Wall Street pros who say that we don't know what we're doing can't possibly understand our non-financial strengths.
Armed with unprecedented access to market information, free trading, and the temptation of potentially explosive returns, individual investors have emerged as a new force in finance.
AMC was on the verge of bankruptcy, but because the stock price went up and they were able to raise so much money, the company itself actually used that money to help them get out of the red. And so that's been a really positive consequence to this whole movement.
This is a movement that has found its voice, rallying on social media, and in some cases, beating the market pros at their own game. Join us now for this Yahoo Finance special, Reshaping the Market. Hello, and welcome to our special on the huge influence that individual investors are having on the stock market, from powering individual issues, we've talked about them a lot, AMC, GameStop, to also lifting the overall market to record highs. Joining me now, my colleagues Miles Udlin, Brian Stasi, and from the floor of the New York Stock Exchange, Jared Blickley. Welcome, everyone. Jared, I want to start with you and your thoughts there. I mean, you are a longtime market watcher, longtime trader yourself, watch the technical levels. How has this felt to you, this sort of period of time, as we've seen this big increase in retail interest?
It's been incredible, and I think it is unprecedented. I was not trading during the NASDAQ bubble. I certainly wasn't trading during the 29 bubble, but I think there are some similarities. But you combine this with the fact that there's been this migration towards electronic trading over the last 20 years, 25 years actually, and the market structure has really changed. And as we were learning during the intro, this has affected the company's ability. If you're a meme stock, it allows you to go into the capital markets and raise money. So there's a direct relationship now between the investor and the company that really didn't exist before. Then you have all the other dynamics. You have hedge funds that are shorting stocks, collapsing. $30 billion Archegos was one day. 2 days later, it was zero. These people, these traders, the retail army, are having an effect on the markets, and it's palpable, and I don't think it's going away. You take a look at AMC year to date, GameStop year to date. All right, you had those spikes before, but it's incredible the price levels that they've been able to hold. So this isn't a pump and dump scheme. This is simply an investment scheme, and it's a new paradigm.
Jared, well, this is something we'll explore throughout the special today, but where have all these traders gone the past 3 months? It was a phenomenal spike in trading activity in January, but things have cooled down, and so are some of the big stocks that became synonymous with the uptick.
Yeah, I think a lot of activity has fallen into more concentrated hands right now, and the effect that retail investors are having on the market tend to be in those names. So the ones we've been talking about, AMC, GameStop, but interestingly, a few new ones have popped up like Newegg, and I think that's evidence that this isn't a one-time phenomenon. So there's everything happens in cycles. There's an interest, and you see the stock price accelerate. There's a short squeeze, and that's important because when the shorts get squeezed out, a lot of times you just have that collapse back to reality, and then the stock kind of meanders and goes on its way. Not necessarily the case with a lot of these stocks. They're holding their gains, and that's why I think this is a little bit different.
And I think you also can't forget about, to some degree, crypto and its role in all of this in terms of retail investors being interested. We saw a resurgence in crypto, one of many, of course, but that's part of the whole phenomenon as well, even as we've gotten into this period where things have been a little quieter on the meme front.
Yeah, and another thing to remember in all this is that the number of companies that are listed on the public markets has been collapsing over the last several decades, right? There's been fewer options for investors of all sizes to choose from, and on the backdrop of that is the traditional financial industry of you get some analysts, they cover some stocks, they give you stock ideas, they call some dentists, and then they buy the stock. I mean, that's been dying. That is dying, right? It's a dying business. BlackRock and Vanguard are killing traditional finance in many ways. And so to see retail investors, I think, end up with a more even footing, not only because the internet democratizes information, the internet has democratized access to trading, and obviously there's a conversation around what that access looks like with the Robinhood IPO, so on and so forth. We'll talk about that forever. But I think that we have this weird scenario where retail now has more of a voice than they've had in some decades, at the same time that the actual hedge fund world that they're apparently fighting against is in collapse. Performance has been terrible. They've underperformed the market. They're getting allocations pulled. It's all about private equity now instead. And so I think it's an interesting duality there.
Yes, it is. Although in some cases, the hedge funds are now chasing the retail performance. The surge in these stocks recently, particularly the meme stocks like AMC and GameStop, it all started on the subreddit Wall Street Bets. Of course, it's been around for almost 10 years, had about 2 million users, but this year its influence has exploded. It now counts over 10 million users. Wall Street Bets founder Jamie Rogozinski is with us now. We're talking with Jamie once again after we've been checking in with him regularly as this has all been going on. Jamie, it's good to talk to you again. And just to let folks know, you're no longer affiliated with Wall Street Bets, but certainly you have some perspective on it as somebody who helped found it. And so with that perspective, and now as we have some months between us and the initial sort of really spike in some of these meme stocks, I'm curious how you're thinking about it, what your perspective on it is, and what you think the ultimate legacy of this will be.
Well, first off, thanks a lot for having me. And I think that this is definitely far from over. I think that people, retail investors specifically, have realized that they do indeed have a voice in the market and that they're able to exercise their own decisions on the market itself. And the democratization of the markets has really taken effect. I think it's incredible the fact that we're having companies using capital markets to raise capital, right? Like that's what the stock market was meant to do. Just wait until these meme stock investors realize they can vote with the shares they're purchasing.
Well, and they realized that with Lucid in the most recent case, right, where there was a little trouble getting all the retail investors to vote to approve that SPAC merger. Do you think, there was a lot made sort of in the early days of this, these investors don't know what they're getting into, they're going to lose money. That kind of stuff, even though some of these stocks have come down, those anecdotes have not necessarily seemed to materialize. Why do you think that is?
Look, there is a paradigm shift, right? There is a lot of people that have been in the market for years or decades and have seen a lot of cycles come and go like this. But this time it's a little different because of the amount of the sheer number of retail investors that are coming and staying in the market. At the end of the day, the name of the game is trying to make money, and these guys, girls, these people all over the country are making these decisions based off of whatever they believe is right, and they have such conviction that they're able to hold the prices up the way that they have been for almost more than half the year so far.
And Jamie, it's Miles here, and I'm curious what you think about the role that the different platforms play in this. Robinhood gets a lot of the press, but there are plenty of other trading apps where you can trade for free. You can trade in size for free, and it really makes access to markets a lot easier for investors of a smaller size who aren't paying $3.99 or sometimes multiples of that per trade. How do you think about that in this dynamic as well?
Well, look, I mean, Robinhood deserves all the credit they do that they get because they disrupted the market. They were the first. They came in. I think they're the biggest one to this day. But they pushed all these retail, all these brokers that have been around for years or decades to also become more competitive, and they just make this more accessible. As far as I'm concerned, I think the next wave is going to be when we start seeing stocks being traded on the blockchain, like in the cryptocurrency world, right? If we're talking about reducing the barriers of entry into the market, crypto is already getting into tokenized stocks to being able to purchase, and then really the floodgates completely open.
Jamie, speaking of Robinhood, Robinhood is set to debut at some point later in the week on public markets. Do you think the retail investor crowd is poised to really get behind this IPO, and what does that mean for the stock price out of the gate?
I mean, we'll see what ends up happening. I think a lot of people are still a little upset with what happened with Robinhood during the GameStop saga. Although it wasn't just Robinhood that had these issues, all brokers had issues. There was congressional hearings about it, but I think that people still have their feelings hurt. But at the end of the day, the people that are investing in it are different than the people that are using the broker. And I don't think that people have really stopped using Robinhood. I think that they deserve all the credit they've gotten for disrupting, for innovating, and they continue to do so. They're trying to get into private investments. They continue to try to push the envelope, and they're trying to get it more into crypto. And I believe that they're going to be very successful with that.
Hey, Jamie, I'm curious about you at this point a little bit. I know that part of the reason you moved away from Wall Street Bets was because you weren't happy with some of the vitriol, some of the language, some of the alleged sort of bigotry that was being thrown around on there. Where are you sort of interacting online with this community at this point? Is it another subreddit? And what are you doing in terms of trading right now?
You know, like Wall Street Bets has now become more of an idea. Of course, the subreddit is the largest presence of it, but you see Wall Street Bets themed communities, whether it be TikTok or Instagram or Telegram or Discord or whatever, you know, there's just, and then a lot of variations, Satoshi Street Bets, Crypto Street Bets, India Street Bets, China Street, like everyone wants to be a Street Bets. And so you can find little bubbles of it everywhere. And I'm involved in, you know, many of those places. Personally, I do believe that the merging of crypto with Wall Street is going to be the next big wave. So I'm trying to stay ahead of that by getting involved with that as well.
Yes, that's something we're watching closely also. And finally, my understanding is that you have sold your rights to the story to potentially be making something in Hollywood. Any progress on those projects? Can you maybe break a little news? Tell us who's going to play you in the movie, Jamie? I don't know.
I'm allowed to say that there's plenty of progress being done. I think we're going to be able to see some of these results probably maybe early next year, mid next year, but everything's moving along quite nicely with that.
All right, we look forward to updates in the months ahead. Jamie Rogozinski, founder of Wall Street Bets. Jamie, great to speak with you once again. Thanks for jumping on and spending some time with us. All right, still ahead on today's special, we're going to talk to the CEO of one company who has seen their stock surge this year, perhaps on some meme names, but also on some breakthroughs and the company's efforts to treat some neurodegenerative disorders. We're going to talk to the CEO of Anavex Life Sciences coming up here in just a few minutes.
Welcome back to Reshaping the Market on Yahoo Finance Live. Wanted to get a little perspective on what we mean when we say meme stocks or when we talk about this phenomenon. And our Jared Blickery has built this list, this heat map of all of these different stocks. I'm taking a look at the year to date for them. Now, right now, they are ordered in market cap weighting. So the biggest stuff, Palantir, Rocket Mortgage, Nokia are on the left side. But let's take a look at the equal weight to look at the year-to-date performance of these stocks. And as you can see from this, the majority of them, the vast majority of them, it's fair to say, are positive on the year, and in some cases are positive in pretty dramatic fashion here. But of course, the sort of poster children, if you will, of the meme stock phenomenon are two stocks in particular. I'm talking, of course, about AMC as one of them. And here's the daily chart of AMC. Let's take a look at the year-to-date chart, shall we, to see what we have seen here this year. And so this is an interesting one because now, at the time, this looked like a big move upward in those AMC shares. The company at the end of 2020 said it was concerned that it would even have the ability to continue being in business because it was running out of cash. Movie theaters were closed, of course, for most of 2020. So it had a blip upward then, but really the resurgence in the stock and the bigger move upward in the stock came in June. And that's when, yes, the company started seeing a resurgence on message boards. It's also when the company a little bit more explicitly started addressing the retail investing public. The CEO, Adam Aron, did that multiple times, tweeting at investors. He ended up selling shares to the public, which ended up being successful in raising cash for the company, even though another attempt to get licensed to sell more shares was not approved by shareholders. But nonetheless, you see that impressive performance for the year. And then, of course, just quickly, the other stock that we talk a lot about is GameStop. And again, this was sort of the pioneering meme stock, if you will. These shares up 865% year to date. They had their big spike, and they have not regained those levels, unlike AMC, but still, you guys have gotten a lot more dry powder to use. That's what's been, and I know this is a theme you've talked so much about, Miles. Yeah. This is cash that the company can use.
Well, and I think the thing with the GameStop chart, you look at it, the stock was trading in the 40s when Keith Gill, also known as Roaring Kitty, went to Congress. And everyone was like, this guy is so crazy for loving GameStop. What's he out here talking? He's saying, he's telling members of Congress, I like the stock because it went from 4 to 40. Now it's at 182. And I think that this second and maybe even third leg of this story is why we're sitting here on July 26th still talking kind of about these same names.
What makes this AMC move pretty impressive really is we've seen now 2 quarters of robust growth out of Netflix. Still, they're gaining a lot of subscribers. Disney Plus, a lot of subscribers. Paramount Plus, lots of subscribers. And here you still have a stock that's up close to 1,800% year to date, despite the movement to the shift in streaming, a fundamental movement. But worth noting, too, look, GameStop, relatively underperformed for AMC.
Yeah.
That's right.
Right.
Yeah, if you were going to buy one of them, I guess AMC would have been the one. Although 800%,
what's the 1 year? Actually, what's the 1 year on AMC?
This is
because that's a 1 year on GameStop.
This is the 1 year on GameStop. All right, let's just do it real quick. AMC, take a look at the 1 year instead of.
Yeah, see, 890. Yeah. So GameStop really is still the golden goose here.
Timing was everything though when it came to these two companies.
If you were on Wall Street Bets a year ago, you would have seen Deep F and Value talking about GameStop, and you'd be up 4,000%.
Not bad.
Well, I mean, it's not that easy. Life isn't that easy, but there's a version of that out there.
He's the version of it.
He's the version.
Yes,
yeah, that's right. That's right. Although I think he exercised some options, sold some. He's got a bunch of money now. Good for him.
Yes, he does. All right. Up next, a medical breakthrough helps this company's stock break through and produce big returns for investors. Anavex Life Sciences CEO Christopher Missling will be with us next.
All right, welcome back to Yahoo Finance Live special Reshaping the Market, talking about the role that individual investors have had in a number of stocks this year. One of those names is Anavex Life Sciences, a small biotech company recently announcing some big breakthroughs in its efforts to treat Alzheimer's and other neurodegenerative diseases. Stock has been up around 300% so far this year. And we're joined now by Christopher Missling, the company's president and CEO. Christopher, thank you so much for jumping on to talk with us this morning about the company. Let's just kind of start with your guys' story and where you sit in the market right now, $1.5 billion market cap, and sort of what you guys are working towards in your research.
Right. Thank you very much for having me. So we're addressing the large markets in aging, applying precision medicine for both global aging, which includes Alzheimer as well as Parkinson's disease, but also rare diseases which are catastrophic, like Rett syndrome. And we've been very successful so far in providing evidence of a precision medicine platform with clinical data in all of these three indications. And we're continuing with clinical trials as we go.
And Christopher, as we've talked about, the role that small investors, individuals play in the market, and we've talked as a group about how biotechs in many ways are sort of the original meme names, right? We're making a bet that we can have a product, that your company can have a product that will, be the next Moderna, for example. We've all seen that example, and I'm curious, as an operator of one of these businesses, where your focus is in terms of negotiating both what can happen in the stock market, and your stock has had a number of lives over the years, and how you guys day to day are trying to work on some of these treatments.
Well, in medicine, you have to really demonstrate evidence, and it requires a very fundamental scientific approach to do that. And that's what we are able to do. We've identified a biomarker of response, and I think that led to the increase in appreciation, because with a endpoint successful, that could also be then considered maybe not as robust. But if you have the endpoint, which is successful improvement of a outcome in patients' life, that can be associated with a biomarker of response, which is completely independent. That makes the whole story much more consistent and complete the evidence to this. And that's what we're able to find. And we are very proud about that we found this unique biomarker of response, which is specific to our drug.
And I'm curious, I know we're in the weeds here on the science of it, but from a lay perspective, sort of where in your research, is the right way to think about it, where within the brain are you guys working? Is it within the central nervous system? And how are you approaching, again, I think Parkinson's, Alzheimer's, everyone understands that. How are you approaching potential treatments, against those diseases?
Yeah, these are very different indications. Parkinson is more like the movement impairment, Alzheimer is the cognition, and then Rett syndrome is another effect on a combination of these factors, cognition and movement, which is genetically mostly caused. And we found that in the brain, in the central nervous system, there is a constant struggle in these indications, which we call a cellular stress. And this can be alleviated or reduced or compensated by a protein called sigma-1 receptor, and we activate that protein. And we can show that this activation can be also tracked with a blood biomarker, and it shows the correlation of the effect of the drug with the increase of this sigma-1 protein in the blood.
Now, Christopher, when I look at your guys' latest investor presentation, I see here, high up, establishing an mRNA predictive biomarker of efficacy in Alzheimer's. And of course, unfortunately, I've, like many people, have learned a lot about mRNA over the last year. And I'm curious, where that fits into, what we've all learned with Pfizer's platform and Moderna's in terms of COVID development, and if that is indeed the same idea, and how you guys are approaching that.
Yeah, very good point. So mRNA is a messenger RNA. It's the determination of our protein gets expressed in the body, which is the functional part of the body, if you so like. And we were able to show that our drug activates the mRNA. So while Moderna brings the mRNA from the outside, we activate the mRNA inside in the body by small molecules. So our Anavex 2-73 compound, our drug, is a small molecule you can take once daily orally, like a mini aspirin, if you so like.
Now, when you guys came out with your latest results in May, you mentioned you guys had 3 years of cash on your balance sheet. In June, you were able to come to market raising $50 million in a private placement deal. By my math, that gets you guys to 5 years of capital on the balance sheet right now. How is that, what are you thinking about in terms of that runway? And is it the market that was able to get you guys there with that capital raise, or is it, what you're seeing in your results that really gave you the confidence to go and raise that money?
It was really the interest of the fund, which came in a very blue chip biotech fund, dedicated biotech fund, who put the entire 50 million to work in a direct investment. And we just were, we were aware as a biotech company, you constantly need to have resources to continue to do excellent clinical trial studies. And the stock was moving up positively based on data, and that led to the decision to allow this investment to take place in order to have now 5 years runway, as you correctly described.
Yeah, and that capital raise getting done at $21 a share, right where the stock is trading today. And Christopher, before we let you go, I do want to ask a little bit also about the grant you guys got from the Michael J. Fox Foundation for your work on Parkinson's, and sort of where that fits into the picture as well.
Excellent point. So the Michael Fox Foundation awarded us a second grant. The first one was to confirm for the first time that Anavex 273, our drug, was indeed showing a response in Parkinson's disease. And there was a dose trial which done in animals to show disease modification in Parkinson's disease with our drug successfully. And that led to the next investment from Michael Fox to provide us a grant, which is not an investment, it's like a grant without any recourse, to now put this to work into a clinical study in Parkinson's disease.
All right, Anavex Life Sciences CEO Christopher Missling. Christopher, I hope we can have you back when you guys have more positive news on your development. Thanks so much for jumping on with us this afternoon.
Thank you very much for having me.
All right, coming up on the other side of this break, we're going to check back in with Jared Blickery, some data that he's been looking at to really give us the scope of just how much retail participation there has been in the market over the last year. This, of course, just days ahead of Robinhood's IPO. We'll be back with that conversation coming up here in just a couple of minutes.
What is up, everybody? Welcome to Trades. We freaking talk fast and don't skip class. I like to preface by saying that I'm not a financial advisor or expert, so take what I say with a grain of salt. Let's get into the video. Let's just talk about what's going on here. So I want to give you a little bit of an update on the technical analysis here, but mostly I want to focus on short interest in puts and how this whole sort of equation can work, because I think this is something that's not really considered in terms of what can be considered short interest in any given stock. So I want to talk to you about how puts actually affect the market. So let's just talk here about how this would end up working. First off, short interest on AMC right now is about 14.36%, 73 million shares or so, has stayed about the same, floating back and forth between 14 and 15%. And we're going to have to wait until probably tomorrow to see any sort of returned shares that could have come in the last 2 days, because you did see, a pretty decent push, not yesterday, but 2 days ago. So maybe that's actually today. But if there was any sort of shares that were returned on that push 2 days ago, they'll show up here today. So you'll be able to see that. Just check up on Ortex, you'll know the whole picture. But most importantly, that I want to talk about is this overall sort of put hedging that can take place. So gamma squeezing can take place on both ends of things, most typically on the call option side, because there's infinite upside for a stock. Puts, though, when you gamma squeeze puts, the only amount that you can make is if it drops down to zero. There's limited returns in terms of a put.
That was Trey Collins of Trey's Trades. Just a little taste of what's out there right now. We were talking at the top of the show about how it used to be if you wanted information of this market, there was only a few places you could get it from. Now, you have a lot of YouTube channels like Trey's, a lot, that cover all kinds of different aspects of the market. Now, his happens to be quite popular. He's got, something like 400,000 subscribers or something.
Many as us.
Yeah, so, there is this whole upsurge. I don't know what else to call it.
Miles, I am reminded, we've talked about this repeatedly throughout this year. To traders like that and folks like that, fundamentals don't matter. They're looking at charts, they're trading momentum.
Some of them do. Some of them talk fundamentals. It's not all about technicals, those people who have a lot of followers. Someone we talked to who looks at technicals is Jared Blickry, and I want to go back to him on the floor of the New York Stock Exchange, because Jared, you're looking at charts, not technical charts necessarily, but you're looking at some of the charts that help us explain this phenomenon that we're talking about.
That's right, and we'll get to those slides on the Wi-Fi Interactive in a second. I just want to say, kind of reacting to your comments, this has been fantastic for the industry, getting new blood into the industry, people learning about different methods, fundamental analysis, technical analysis, what is short interest, and this is great, and hopefully this can continue, but we've seen a lot of damage done to some of these trades at various times. You get a big spike, and they pull back, people playing the options market. But let's get to these charts here that I have on the Wi-Fi Interactive. The first shows how the retail trader has become an increasingly big part of the market, and this is tracking market volume. So back in 2011, that's all the way at the left, retail traders accounted for 10% of the market. By 2020, this spiked up to 20%. We are now close to 25%. So this is just one illustration of the dynamics involved here. So we go to another chart. This goes back to April of 2020, so kind of the beginning of the COVID recovery, at least in terms of the stock market. This shows options market share. So very similar to the other one. And you see that it spiked up to 17, 18%, then it's kind of been trending down. But look at this, we do see an inflection point here, and we're breaking to the upside. So you can do technical analysis on this if you'd like to. I'm serious here, and a lot of these trades have been fueled by a surge into mega caps. So mega caps were on love for a period of time. Over the last 7 weeks now, they've really outperformed some of the best performers of the month in NASDAQ 100. And the third slide I want to show is here are two potential portfolios. So the light blue line, the cyan line, that's the S&P 500 performance. And then if you bought half of the NASDAQ, put 50% of your money in the NASDAQ, so the big caps and tech, and then 50% in the Russell small caps, you actually have much greater performance. So we're talking about S&P 500 being up about 25, 30% versus this basket of half NASDAQ, half Russell up about 50%. Why is this? A lot of these meme trades, they have to do with small cap stocks. So we've seen a lot of those surge. And in terms of the NASDAQ, we've also seen a lot of surge into mega caps at various times. So you put those two together, pretty interesting that the performance is so much greater with this particular basket. Final slide here. I've showed this several times on our shows throughout the last few weeks. The red line is a NASDAQ 100. This goes back to December, November of last year. And you can see that it has been peaking here at record highs. But this other line here, this purple line, is the breadth. So we haven't seen as many stocks participating in this rally. That has to do with the concentration. So various reasons for that, but the retail trader is a part of it.
And just a couple of points on the back of that, Jared. For people who maybe haven't been following this all the way along, or even if you have, what do we mean when we say retail trader, right? Because you see the figure frequently cited, half of all U.S. households own U.S. stocks. So when we're talking about retail traders, we're not talking about obviously stuff that people own in their 401ks or own in their pensions or own in their IRAs. We're talking about people at home, usually in front of a computer, making trades on individual stuff. So that's point one. Point two, we tend to put these two parties in opposition, retail versus institutional. But of course, as we've talked about very frequently this year, they're not always in opposition. Mm-hmm. And when, the small guys are up against the big guys, sometimes the big guys are making money on the same trade. So.
Well, and I think really as Jared goes through this data and you sort of think about this market moment, I mean, it comes back to this idea that I've talked about in a number of contexts on this show and kind of elsewhere, that everyone knows everything. I mean, there is so much information that when retail starts to sniff out a trade or retail's loading up their bets, institutions, hedge funds, they know that immediately. Unusual volume. I mean, forget about just the paid services. There are plenty of free places on the internet, free accounts you can follow on Twitter that will flag unusual options activity, unusual volume spikes in certain names. And I can guarantee you that there are shops with not insignificant amounts of money chasing those trends as soon as they hit the tape. And I think that's why, Saz, retail's influence in a handful of names has been so forceful. It's being followed
Magnified.
by big money, right? It's like their retail is the seed, and then the actual leveraged bets from actual prop shops and the like come in and say, okay, I'll ride that. You guys got an edge here? I'll ride that. And I mean, the reason AMC and GameStop traded where they do is because there's big names in that. That's not just, Joe Schmo at home. Right?
Yeah, I'll just add too, I think we have to split what the retail investor is. So you have, I think, a universe of retail investors. They've been involved in the stock market the past decade since the great financial crisis. I would say meme stocks is the next level down below retail investor. These are really new investors to the market that have joined the market because of the frenzy we saw in January. 10 million new brokerage accounts were opened in the first half of this year. That was the entire total from 2020. Just an amazing stat. But I think we still have Jared down there. Jared, let me ask you this. What we have seen during the market's pullbacks, probably the past month and a half, the retail investors have stepped up. They've been out there buying the dip.
Yeah, that gets back to what I was saying before. And they were buying not only certain meme stocks, but mega caps. I was looking at another chart, don't have it with me right now, but the retail call option volume in the FANG stocks, and then throw some other mega caps in there, Tesla's always in there, that was really increasing over the last 6-7 weeks when we saw the mega caps outperforming. I don't think that's a coincidence. And that's why I'm saying all of this is tied together, and some great comments about what is a retail trader and what is an institutional trader? The definitions can be a little bit blurry, but it goes back to what I've been saying with regard to this entire phenomenon, that once it came to market, it just kind of fed on itself. And there's this really beautiful interplay between not only the capital market structure, but also the trading structure. And I go back to another point that I hope this can continue for a time, and that the retail traders who were buying call options for a while don't get too burned on that.
All right. Yahoo Finance, Jared Blicker live on the floor of the New York Stock Exchange. Jared, we'll check in with you later on in today's program. But coming up on the other side of this break, Brian Sozzi is going to speak to Tim Baxter, CEO of Express, as that company has had an interesting 2021, to say the least. Get into all that coming up right after this.
Many businesses, of course, have had a tough year and a half due to COVID-19 lockdowns, but retailers have been especially hard hit. Apparel retailer Express is now looking to capitalize on the return to work as well as drive a lasting turnaround under new management. Express shares have surged nearly 450% this year as retail investors bank on a turnaround for a company they have probably shopped at for the past decade. The CEO of Express is Tim Baxter, and he joins us now. Tim, good to finally speak with you here. So you just passed your 2-year mark as CEO of Express. How is the company different today compared to when you took over?
Well, that's a great question. It's completely different. You know, when I took over in June of 2019, and I had 3 major objectives when I first joined. One was to establish a corporate strategy. The second was to assemble a great leadership team to both inform the strategy and then execute against the strategy. And then finally, to change the momentum of the business, which had been challenging for several years prior to me joining the company. And in January of 2020, about 6 months after I joined, we launched the Expressway Forward strategy, which was our strategy to completely transform the company. And it was based on 4 foundational pillars. I talk a lot about them. Putting product first, engaging our existing customers and acquiring new customers, brand, reinvigorating the brand, and finally execution. And we've made incredible progress against each one of those 4 pillars, in spite of the fact that we closed every one of our stores and sent all of our folks to work from home about 6 weeks after launching the strategy.
Who is the Express of today?
You know, the Express of today, we are regaining our relevance. You know, I talked about reinvigorating our brand, and you know, Express is a 40-year-old brand. And when I started a couple of years ago, I would say that most people would describe Express as a store at the mall, or they thought of us as a store at the mall. And today, we're moving forward on re-energizing our brand, and we want people to think of us, and people have begun to think of us as a brand with purpose. You know, our purpose is to create confidence and inspire self-expression. It's a purpose that resonates incredibly well with our consumers. You know, they want help getting dressed every day. They want help knowing what to wear for certain occasions. And they look to us for that guidance. And that's been an incredibly important part of reinvigorating the brand. And we're seeing incredible metrics on engagement from our consumers as we have shifted all of our marketing towards supporting that brand purpose and completely changed our assortments. You know, Express in the past, we have been well known and very dominant in categories that many people would have considered wear to work categories historically, or occasion-based categories. And the reality is the American consumer has changed dramatically and no longer really thinks about their wardrobe in that way. So we're also a brand that has an incredibly versatile assortment that can dress our customers, both male and female, for virtually any occasion, whether that's shorts and a t-shirt or a black tie event.
Just given that return to work focus for Express, it's always been a hallmark of your brand. What have you seen more recently? We seem to be caught in this gray zone here. A lot of folks going back to work, but now a lot of concern on the COVID-19 Delta variant spreading. What have you seen in your business so far?
Yeah, it's interesting. We have definitely seen a resurgence in what you would call historically wear to work categories. We saw an inflection point in our business at Easter when vaccinations were continuing to roll out pretty aggressively throughout the country and restrictions were beginning to lift. And the wear to work and occasion-based businesses certainly have had a steady resurgence after that inflection point. I would say, you know, we've seen stronger adoption to occasion-based categories as people have resumed attending weddings. I mean, I think everybody at this point thinks just about everything is an occasion, and they want to get dressed up for that occasion. The wear-to-work categories have had that resurgence, and we continue to see that in spite of what's been happening with the COVID variants and some states going back to certain restrictions. And I expect that will continue based on the data we have as we move into the fall season, particularly post-Labor Day, when we anticipate a very large percentage of the American workforce is going to return to the typical work environment. But I don't think that they're going to return in necessarily the same way that they have. Comfort is going to continue to be incredibly important, even as people return to an office environment.
Tim, it has been a stunning year for your stock. On January 21st, I went back and mined some data off of Yahoo Finance Plus. It opened at $1.16. On January 27th, your stock hit a high of $13.97. What were you thinking while all that was playing out?
Well, I've certainly learned a lot since January, and obviously there's been tremendous volatility in the stock. Our stock had been obviously very negatively impacted by the effects of COVID and having to close all of our stores. And obviously the profitability of our company in 2020 was very negatively impacted by that. So we have stayed incredibly focused on our long-term goal. When I launched the Expressway Forward strategy with our new leadership team, we committed to delivering a mid-single-digit operating margin. And we have stayed focused on that goal. And it is our intent to deliver that to our shareholders, both new shareholders who have joined us this year. We've had a tremendous number, obviously, of new shareholders who have joined us this year, and to our shareholders who have been with us for quite some time. And, we're on track to achieve that goal. I call 2020 a detour on the Expressway Forward, but we are on track to achieve that goal, and we stay focused on driving shareholder value. And to me, that is returning this company to a mid-single-digit operating margin.
Tim, is it also your intent, are you looking to raise capital just based on where the stock price is today? I mean, there's been a big focus by Express on improving its balance sheet. From the outside looking in, this would seem like a logical move.
We have, as you probably know, we have an ATM on the shelf, and we have not stated publicly any plan to sell shares, but we do have it from a governance perspective. As we were looking back in late 2020 at different options to raise capital, because at that time we didn't know how long we would be dealing with the effects of COVID-19 and whether or not we would need additional capital. We looked at that as an option, and as a board decided that we should have that at our disposal should we choose to use it or need to use it. But we announced back in January, actually right before our stock spiked, we announced about $140 million in additional financing. And I said at the time that I was confident that that gave us the capital and liquidity that we needed to weather the storm. And obviously our performance has improved very significantly since then. So I'm more confident than ever that we're on track to achieve, our long-term stated goal of that mid-single-digit operating margin. And we have that available to us if it makes sense.
And Tim, before we let you go, today you're announcing a new social customer program. What is that exactly, and how will that impact the business?
Yeah, we're really excited. Today we're announcing a new community commerce program. And, we have a stated goal also of driving $1 billion in e-commerce demand by 2024. And this is an important next step in the evolution of our digital business. So it essentially, it brings together a group of like-minded entrepreneurs that will be called Express Style Editors, and gives these folks the opportunity to build their own storefronts that they can link through all of their social media and engage with their own followers and earn commission on everything that they sell. And we'll be producing exclusive product for these style editors, and they'll also be able to tap into the entire Express assortment. And honestly, you guys were talking earlier about how many people are looking for flexible opportunities to earn money at home and build their own businesses. And we think this is going to be an extraordinary opportunity for individuals who share our passion for creating confidence and inspiring self-expression to create their own storefronts and drive revenue through their communities. So very excited about that and what it's going to mean for us in the future and how we engage with our customers in a very different, new and innovative way.
Well, we'll know quickly. Tim, your shares are up 12% as you're speaking about all this. So clearly the retail investors, they're rooting for your turnaround. Tim Baxter, CEO of Express, good to see you today.
Great. Thank you very much.
All right, coming up next, we'll hear from the individual investors pushing the market to record highs by defying all the conventions on Wall Street. And then we'll look at cannabis, one cannabis company seeing smoking hot stock gains thanks to the retail crowd. The CEO of Tilray, Irwin Simon, will be here with us.
Welcome back to our special on the huge impact that individual investors are having on the stock market this year. Those so-called retail investors, they're a big part of why the major averages are trading at or near record highs, and certainly why some individual stocks have had a wild ride this year. We asked some of these traders for their thoughts on their trades and the market overall.
Wall Street pros who say that we don't know what we're doing can't possibly understand our non-financial strengths. Money can't buy passion or fighting for what's right for future generations so they don't have to. We are a group unified for change. Our differences have just melted away for the movement, but it's bigger than that now. It's a revolution.
You can't put a movement like this in a box. I do like being underestimated though, so let them keep saying what they want. We like to research, we like to keep digging when things don't make sense, and then we like to shine the light on it. Wall Street pros have been wrong many, many times. It's not about just an opportunity to make life-changing money. It's about bringing awareness to what is happening in the stock market and keep exposing the corruption in it.
That the internet is the biggest open source library full of free wisdom. From Reddit subs, Discord groups, and of course YouTubers like Trey, I learned so much about technical analysis and the market behavior for free. I want to see a change happen for future generations of individual investors, for the retail traders. I want a fair market. No more FTDs, no more dark pools, no more payment for order flow, no more synthetic shares, no more naked shorting, no more 1%, only 100%.
Started investing in AMC at $6. Doing a lot of research and digging, and I did not understand how corrupt our financial institution really was. So when I first got into AMC, it was a swing trade. I didn't plan on being here 7 months later. However, the corruption, the lack of information, the absolute mess that our stock market is because of rich, uncaring, greedy, I don't even know where to start. So now I'm here for a different reason. And I've continued to buy and buy and buy.
I've seen numbers in my portfolio that I've never had before, and I've watched it go away as quick as an instant. I'm not scared of my investment, however, because I believe in the trade and I have strong conviction.
So what do I have to say to the Wall Street pros that say that we don't know what we're doing? Well, first I'd like to say I bet they'd like that. They'd love it if we didn't know what we were doing. And personally, I mean, 6 months ago, they were right. I didn't know what I was doing, but I knew that too. Like a lot of the new apes beginning their trading careers, we all understood that we had a lot to learn. And so that's what we've been doing. And I think that that's something that maybe they haven't realized. Maybe they think we're the same people that started 6 months ago with started our trading careers. Well, we're not. We've done a lot of learning as a community so that we can bring each other up and have better financial futures. The apes are here to stay. We're not going anywhere. And as a community, we're going to be fighting for a freer, a fairer, and a more transparent market so that everyone has equal opportunity. And I'd like to hope that the SEC will take us seriously, even if the Wall Street pros won't.
With me once again, Miles Udland and Brian Sazzi, and also from the floor of the New York Stock Exchange, Jared Blickley. Apes, for those of you who are not familiar, self-explanatory probably from what you just heard. It's the folks who are doing this trading. Particularly, I think it came from AMC.
Yeah, it's AMC.
Right,
yeah.
apes. I don't know what the exact origin.
Don't have a full etymology for you, but
no paper hands with those folks.
Right.
Yeah. So what do you think when you listen to these folks and what they're saying about what they've been doing?
Two things. One, they're quick to say that the stock market is corrupt and Wall Street is corrupt, and I understand their thinking, but what about the companies they're investing in? It's not like AMC, before this retail Reddit frenzy earlier this year, was really forthcoming in disclosures. They report their reports at SEC, they do their things, but they were just like any other company doing their earnings calls, and I would say arguably keeping things from retail investors and many other investors for that matter, just like so many other corporate companies out there. And number two, let's see how good these investors are, these apes are, in a market that is not going up seemingly every single day. When that market pulls back, let's see how much pros, how much they are going to make in this type of environment when things change.
I come back to the phrase, are we here to make money or are we here to be right? And when I hear these comments, I hear a lot of people understanding that you're here to make money in the stock market. You're in the stock market because you think you can turn dollar amount X into dollar amount Y, and Y is larger than X. And yes, there's a lot of commentary in there about worldviews on market corruption, this, that, the other. And, some of that isn't wholly untrue. As a general framework, the world is not a conspiracy. So that would be the way that I would tend to hew on that. There's certainly favoritism in capital markets, like there's favoritism in anything else. But basically, it doesn't really matter if you think it's a conspiracy or not. If you're in the market and you're making money being in the market, then you understand the point of investing.
Right. Yeah, that seems pretty straightforward. Jared, you were talking about how you think that overall this is a good thing, more people involved in the market, more education being had. And I thought it was really interesting, Sean in particular, who we heard at the end, saying we've learned stuff along the way, that it's not just, we're not static. What do you make of some of those comments that we heard?
That learning process is very important. One of the worst things that can happen to a new investor is you make some really big outsized profits from the get-go, because that never continues. It doesn't go on forever, so you have to learn some hard lessons. Most people blow out one or two accounts. They have to refund them. On the street, they're using other people's money, so maybe not as big of a deal. If you do something once right, even if you blow out, you get another chance. It's not the same with the retail investors. And then to the point of corruption and all this, let me tell you a story about Al Capone, all right? He came to the floor of the New York Stock Exchange over 90 years ago. So you went to federal prison in 31, so this is probably the late 20s when we had another rally underway, another mania. And after he became educated on the role of the specialists down here, now called direct market makers, said, I'm never going to put a dime into this market. It's too corrupt. I'm not sure he had the best handle on it, but there's always been edges for insiders forever. That's going to continue. They get paid for their job. It doesn't mean that there aren't edges for retail traders. There are, but you got to go through the process. And it takes a long time, but it's fun. So if you're so interested, if you're so inclined, you put in the legwork, you put in the effort, you learn about the markets, I think you're going to be a better person for it.
Al Capone saying something was too corrupt for him to get involved in. Maybe that's because he didn't have the reins of the corruption in that particular case as he saw it. Who knows? I want to turn back to one stock that we talked about earlier because it's on the move higher. Brian Sazza, you just talked to the CEO of Express. Yeah. Express right now is up 16%.
Yeah, it was up close to 20%. The retail army coming out in force after we just talked to CEO Tim Baxter. Two things I picked up on. One, to me, it sounded like a business that has continued to have momentum into the third quarter, despite spikes in COVID-19, which may be impacting the broader retail. So it seems to be that the work attire that they in fact sell, which is a big portion of the assortment, is selling well. Number two, he didn't rule out a capital raise because of the stock price increase, and I think that's very interesting.
Interesting indeed. All right, we are going to come back to that. But first, I want to talk about another segment of the market that has sort of been memified before. It's been a popular area with consumers, with retail investors, talking about marijuana, the business of pot. And it looks like it could now get a big boost from Congress this year if, it is a big if legislation to legalize weed on the federal level is passed. So far, those efforts have fallen short of expectations. But even if the feds dither, states are moving ahead, of course, with their own legalizations. That is potentially good news for companies like Tilray if it moves to the national level. I spoke with the company's CEO, Irwin Simon, and he, remember, was a founder of Hain Celestial, the natural products company. So we talked about his pivot and his model there and how he's applying it to cannabis.
You know, I was the founder and CEO of the Hain Celestial Group, which you and I talked many times on. It was a roll-up in the natural organic food, personal care, and protein industry. And when I started Hain in 1993, there was not a lot of investors or consumers that knew about natural organic and all the benefits for it. And, you know, Hain grew into a $3.5 billion company, and at the height, you know, close to a $7 billion market cap. And today, that's all we hear about in the whole food industry today is natural, organic, clean ingredients, GMO-free. So now let's revert to the cannabis industry. You know, when you hear cannabis, you think of marijuana, you think of weed and everything else negative that went along with it. But that industry, too, is changed dramatically. When you think of cannabis, you think adult use and what it ultimately does from relaxation, from giving you a little, you know, energy high, etc. And cannabis also used in lots of different medical formats and medical reasons. CBD, THC is also used in multiple drinks today. So I see a lot of similarities. But I'll come back and say this here. The cannabis industry in the U.S. is over a $100 billion industry. You know, the natural organic food industry was about a $60 billion industry. So the cannabis industry is a much bigger industry, a much bigger opportunity. And my playbook here is to create, you know, the largest cannabis company that's built around consumer brands. And those brands will be built around adult use, will be built around medical cannabis, will be built around drinks, edibles, and food.
And you guys already have pretty impressive market share in Canada. What needs to happen? What are the inroads in the U.S., but also what legally needs to happen for you guys to expand and grow market share in the United States?
So number one today, as you said, we have approximately 14%, you know, plus market share in Canada, with the objective to get to a 30% share, and that's both in the adult use and the medical cannabis world. In regards to the U.S., we don't do anything in cannabis today in the U.S. We don't touch any flower. We don't do anything because cannabis is not legal in the U.S. from a federal standpoint. We do sell Sweetwater beer, which is a great beer, and we do sell Manitoba Harvest, which is hemp-infused foods. Until legalization does happen, we cannot touch the plant and not touch anything in the U.S. as we're both in NASDAQ and Toronto-listed, stock exchange company. But with the Schumer bill and the Booker bill that's in place, or that's been proposed today, I see over the next 18 to 24 months that cannabis in some format will have legalization. And what does Tilray do? I think as we look at what companies are out there, that do we look at having options on them to buy it once legalization happens? Do we have some type of relationship with them? The answer is yes, and that will give us the opportunity to be a player in the U.S. once legalization does happen.
And how do you see yourselves competitively versus the companies that are already based in the United States, in states, for example, where we've seen legalization?
I step back today, we participate, we're one of the largest market share, growers in Canada. In regards to Europe, we're one of the largest companies today that, process and distribute medical cannabis. And we do have, a drink business and a food business. We have a strong balance sheet. In regards to legalization happening in the U.S., I think we will be ready to partner, buy when that does happen. But right now, there's very little I can do other than own an option or potentially partner with someone when that does happen. And that keeps us a NASDAQ listed company and a Toronto Stock Exchange company, which allows us, to have a different shareholder base. We today trade from a liquidity standpoint, 20, 30, 40 million shares a day. And, that's the difference because we don't do anything in the U.S. But trust me, when legalization does happen, we will be ready one way or another to be a part of it.
You mentioned the shareholder base, and that brings me to sort of the unifying theme behind the companies that we're going to be talking to, which has to do with retail ownership, retail interest in the company. And we've seen sort of different approaches that CEOs and leaders have taken to this. How are you thinking about the retail investor community and how much you want to sort of court them directly?
So, Julie, I love to hug my shareholders and I love to hug my customers, consumers, and today also my employees when you can. In regards to our shareholder base today, almost 80% of our shareholder base today is a retail shareholder base. And I love it because they're sophisticated, they're educated investors. In regards to technology, they're very smart. And they're consumers of our products. And they put their money where their mouth are, and they've invested into Tilray. So very much so, I am a big fan of retail shareholders. And I was one of the first CEOs that came out there and said, welcome investor, welcome retail investor. With that, on the other hand, and, at Hain and other public companies that I've been involved in, having the institutional shareholder is something that's very, very important. And today, probably somewhere around, and again, approximately 20% of our shareholder base today is institutional shareholders. Institutional shareholders can own Tilray shares because, like I said, we don't touch the plant in the U.S. And that is, one of my jobs is to get out there and continuously bring in the big institutional shareholders to be investing in Tilray and taking them through our story and our strategy, how we're going to grow this company, what we plan to do if legalization does happen, where medical cannabis is a big part of our business, where ultimately cannabis-infused foods are a big part of our business. So, I would love to go up to Boston and be visiting a lot of those shareholders in New York that are big institutional shareholders.
When it comes to the retail shareholders, have you gotten creative or rethought at all
how you communicate with them in terms of technology, in terms of social media, et cetera?
Listen, it's a whole new world for me how I communicate with them. It's almost like how do I communicate with my kids every day is the way I communicate with my, retail shareholders. So yes, from a social media, I'm out there trying to talk to them every day. As a MAME stock, we're out there, getting information out. And from a digital standpoint, getting messages out. We're in the midst right now of, looking for our shareholders to approve additional shares, because when we did the reverse merger with Tilray, there was no shares left within the company, and it's important to us to have additional shares to do acquisitions, ultimately with U.S. legalization in place. And, I'm out there almost every day, whether it's telephone messages, whether it's video messages, making sure we get out there and get that right message to our shareholders. Unfortunately, it may be a shareholder today and they're not a shareholder tomorrow. So keeping up with your shareholder base, it can be somewhat difficult. But you got to get out there and communicate to your shareholders. You got to talk to your shareholders. And, I will come back and say they are educated in regards to what you're doing.
That was Tilray CEO Irwin Simon on his relationship with investors. Up next, what do professional traders make of the influence that we have seen individual investors gain in this market? Will it continue? Capital to Market President Keith Bliss is going to join us from the floor of the New York Stock Exchange with our Jared Blickery.
Welcome back to Yahoo Finance Live. I'm Jared Blickery. We're talking meme stocks. And guess what? We got Keith Bliss, an OG member, at least it's going back 5.5 years since I started Yahoo Finance. And you're currently with Capital to Markets, but you've seen a lot here change on the floor. I'm just wondering what you've seen also from your perspective over the last year, given what we're talking about, the rise of the retail trader.
Yeah, well, it's amazing. First off, it's good being back here on the floor. It's the first time I've been back here in a year and a half. So, yeah, I mean, some things continue to evolve and change, but as I was telling you earlier, I recognize every face that I've run into, so it's good that so many have been able to retain their positions. But listen, when it comes down to the retail trader, given the continued evolution of technology, continued evolution of access to the overall markets, even what we do at Capital to Market, which is reaching that retail investor for private offerings, it's been the era of the retail investor where they've seized control a little bit of the markets, not only the meme stocks, but also in other areas. And I think that'll continue to happen that way. The institutions will try to re-seize control, but it's going to be hard to do.
Yeah, it's kind of like a game of spy versus spy. We've been talking about Reddit and the various forums, but you know the hedge fund guys are in there. They'd be remiss if they weren't. So I'm just wondering how you see the interplay of the institutions and the retail players just kind of coming out over time.
Well, what goes on those forums, and if you go all the way back to, shout out for you guys, 20 years ago, we were reading the Yahoo forums when I was at Knight Securities, a large market maker back then. The institutions absolutely pay attention to it. It's a data point that they watch. If they don't, they would be foolish because they'll just get run over by the momentum that happens. So even big quant shops are now able to read in those messages from Reddit and the other message boards and feed that in as one data point amongst thousands that they're doing there. So they've become a very important part of trading, not only for retail, but for institutions and for places like this.
Yeah, and you mentioned Knight Capital. I wasn't where you worked there. I mean, they later blew up for a different reason, but it just goes to show you the danger of this business. I mean, Archegos Capital, $30 billion one day, $0 2 days later. And the retail army was a big factor in that. So it just kind of shows maybe there is a little bit of hubris here. I'm wondering if you see that dynamic changing over time.
Well, the one dynamic that will change is, I think, big institutionally driven hedge fund players will not get out over their skis the way that Archegos did, which is the case, right? But what the instructive part of that whole episode was that these bigger players, they're not the 800-pound gorilla in the room anymore. It is the retail investor, and again, the technological advances that we've witnessed over the last 5 years, as well as access into the markets, the reduced barriers of entry for retail investors to come into the markets has really pushed this around. Now, the one caution that I will say is that what's happened in trading with retail, what we could see, especially with the Reddit users, Wall Street Bets and some of the other things, is that they've actually gamified trading. And this, of course, is one thing that the institutions are having a hard time dealing with, because when you hold sway in all of the markets and you carry what we call the axe around in the markets, and then suddenly somebody else is moving you around like a pawn on the chessboard as opposed to you moving all the pawns, that's a big deal. I dare say that the institutions are thinking right now how they can kind of win back that mandate, but it's going to be tough to do given where we are in the markets.
Well, last question here. I mean, we've been talking about risk management, the importance of retail traders learning the game, learning the trading game, and there's a lot of discipline involved. I'm just wondering how you see that evolving as well, because as we've done webinars about this, the importance of know your risk and risk management.
Well, that's the case. I mean, it's going to come down to how much discretionary income you have and how savvy you are and educated you are about the markets and trading and what you can do with your capital. The real risk that I see, though, is that if Wall Street as an industry starts to get too aggressive with outsized leverage parameters, there are rules and regulations which limit the amount of leverage you can extend to someone, but how far are they willing to go? And again, I think retail traders will come to the standpoint, probably, I dare say, when a few of them lose on a number of bets, to become a little bit more rational in their trading. But if they're able to pile on to a meme that's going on right there, and the meme becomes a self-fulfilling prophecy, they're not going to learn many lessons there other than to pile onto the meme and make some money.
Yeah, wise words here. Keith Bliss, Capital Markets, thanks for joining us. We'll be right back.
All right, welcome back to Yahoo Finance Live. Taking a look here at some of the meme names that we've seen inside the Wi-Fi interactive touchscreen. Earlier on in the program, Julie Hyman went through the big stars of the show. Of course, top left here, AMC, GameStop, a couple names that are up several hundred percentage points this year. Brian Sozzi spoke to Tim Baxter, CEO of Express, as well earlier on in our program. But we had these intermittent themes that came up, intermittent names, right? Wendy's is one that really stands out. Now, the stock's only up 4.2% this year, but I mean, I remember we came in here to work one day and all of a sudden Wendy's was up 30%, 40% maybe, right? And there was no reason, and it came back down, right? It came and it went. One of my other favorite trades that happened in here was the way that the memes got memed, right? There were groups within the memes. The Killer Bees at one time was a story within that. That would be a name like a Bed Bath & Beyond, and we're going to hear from Bed Bath CEO Mark Tritton later on in the program. This stock, obviously, you look at the chart, has had a couple of acts over the last year. Also in there is BlackBerry. BlackBerry, everyone loves their old BlackBerries that we don't get to use anymore. And sure, there have been some developments on its software over the years. But as you see, a big part actually of the meme, the initial meme rush, and one of the few names that I think had that kind of spike. I mean, mid-20s here for a stock that's trading at 10, and never really got all that much momentum back. Another part of the Killer Bees, Build-A-Bear. There are still Build-A-Bears out there. The stock is up 600% so far this year. Retail play, Sozzi, the mall, reopen. Where are we doing with Build-A-Bear here?
Just cute, cuddly bears, and if you're going back to the mall, why not stop and Build-A-Bear? I love that place.
Everybody could use a bear in this environment, right? I think it's good. It's good. The Bulls are doing so much winning with stocks up all the time. We'll have one for the Bears. And so I think, guys, that just kind of speaks, going through the board here, of some of these names that came and they went, and the way they were grouped, I think speaks to the internetness, if you will, of what we've seen here.
I'm old enough to remember when you saw a spike on a chart, like that Wendy's chart, your automatic assumption was fat finger. Somebody made a mistake, a trading error. Now we immediately assume it's because somebody mentioned it on a chat board.
That's right. I mean, for years, we were still living in the glow of the flash crash, right? And so the flash crash had to be associated with flash up crashes, right? And now we can all agree that when a name goes up 40%, there doesn't need to be a reason.
I thought the stock was just responding because I ordered 2 fried chicken sandwiches from there.
There you go.
Best spiciest chicken sandwich in the game.
There you go. Brian Sozzi calls it for
Hugging
Wendy's.
Your bear, eating your sandwich.
Spicy sandwich, it's good. It's fine. I don't know if we need to be the best. We'll do that another time. All right, off for a short break here on the side. A lot more coming up on our special covering the reshaping of financial markets. Back with more on all that coming up right after this.
Welcome back to Yahoo Finance's special presentation, Reshaping the Market. One of the other sort of subgroups that you tend to see within the memes is biotechs. And this has been a group that has long drawn attention from retail traders, those seeking potential big upside, because when these companies have a discovery, it can provide a lot of that. The founder and CEO of Ocugen is joining us now. Shankar Musunuri is with us. And Shankar, Ocugen is developing a COVID vaccine. It is called Covaxin, along with a partner in India, Bharat Biotech. Talk to me about where you all are, because you have opted not to seek emergency use authorization here in the U.S. You have had some positive study results. What's the current status?
Thank you for having me, Billy. Very excited to talk about Ocugen and Covaxin today. And we're a biotech focused on breakthrough gene therapies that could be helpful for rare diseases, as well as diseases that impact millions globally. And when this pandemic came through, we couldn't stand on the sidelines. You know, many of us, including some of my team, worked in large pharma, had experience in vaccines. Then we jumped in, and we wanted to do something about it, and collaborated with Bharat Biotech, bring Covaxin to U.S. and Canada, North America. Because it's a differentiated vaccine, it has a broad spectrum immune response. And phase 3 clinical trials, it's demonstrated solid safety and efficacy, including efficacy on Delta variant, which is very unique, because this is the only vaccine which has efficacy against Delta variant from a controlled clinical trial. And where we are with that, we are currently working with FDA on the regulatory pathway, and we have recently completed our submission to Canada. We're waiting for their decision. As soon as, we get the regulatory path underway and we get authorizations or approval, we are very eager and excited to provide this option, this differentiated option to the markets in North America.
And what do you see as your biggest market here? Obviously, a lot of reach of vaccine here in the United States and in Canada to some extent as well, a lot of availability. What do you see as your primary market or markets?
Good point. Once again, if you look at the Delta variant, how it's ravaging through globally, and that's a great concern to everyone. In fact, I got personally, attached to this. I mean, going into personally, my mom, a few months ago, thank God, I got her the first shot of her vaccine, and she got COVID. And, she's close to 80, and thank God she recovered fully. And again, vaccination is very important. I think vaccine hesitancy is a grave concern in North America, too. And how do you overcome that? I think if you provide multiple options, including option of vaccine, which is a platform similar to polio vaccine, which is traditional, and many people with vaccine hesitancy. This could be also a vaccine with efficacy against Delta variant from a controlled clinical trial with unique vaccine data. So providing this option could hopefully, promote and also improve rates, vaccination rates among people. It's important to control the pandemic.
Shankar, unfortunately, we are having a little bit of audio problem, but we would love to have you back very, very soon. And hopefully we can get that worked out and we can have a longer conversation. But for now, we're going to say thank you to Shankar Musunuri of Ocugen. Appreciate your time, sir. Coming up next, Brian Sazi. Spoke with the CEO of Bed Bath & Beyond. We're going to hear about that, about the company's big turnaround plans and the role that small investors are having in that. We'll be right back.
Bed Bath & Beyond is in the middle of a big turnaround plan headed by its new CEO, Mark Tritton. With retailers just reopening after COVID, it looks like the plan is working, with same-store sales starting to climb pretty steadily. I spoke to Tritton inside his newly remodeled New York City store about how he's thinking about his new army of retail investors. Take a listen.
You know, I think you guys were trying to challenge me on, like, how does that challenge your thinking or the way you act? And I'm going to say the same thing to you today. That's interesting, but we focus on the sequential growth of our business and the fundamentals that can resonate with investors as well as customers. And we're delivering those quarter by quarter. We feel strong about that. We're at the beginning of our journey. And the toing and froing in between, we think, is noise compared to the overall trajectory of our brand, our company, and our stock price. And so we're doing the right things, and we won't be distracted by those small moments.
Oh, were you checking the stock price on the Yahoo Finance app?
Yeah, you were telling me in real time online. Look, yeah, we watch it, and we always wanted things to be steady and understandable. And so we watch that. We say, okay, we know we're in a moment in time. It dissipates very quickly for us compared to some of the other stocks. We get back to doing what we do. We don't spend our days watching that graph. We watch, like, is the remodel plan on track? Are we making our sales? Are we getting the goods to the customers on time in full?
And lastly, do you feel a different responsibility knowing that you have all these new retail investors? The institutions, they're always going to be there, but now you have mom and pop investing in your turnaround. How does it make you feel?
I think no different. It's an immense responsibility that we take really, really, strongly and feel really both respectful of the process and our responsibility to investors. Every decision we make is for our investors and our customers, and so we take that very seriously. And whether you've put $10 or $10 million in, our goal is to make you a happy investor now and over time, and that remains the same.
So, of course, guys, had to get the Yahoo Finance app plug in there, too, as well.
Company man.
With good reason. Let's keep in mind, Tritton came on our 11 to 1 show on one day when the retail army was absolutely taking over the stock. As he was speaking to us in real time, the shares were up close to 40%. Now, he has been consistent saying, hey, they have not raised any capital. They remain focused on the long term. But he has a good story to tell these retail investors. We were sitting inside his newly remodeled New York City store, close to 100,000 square feet, a completely different looking store for Bed Bath & Beyond, really compared to anything else they have open across the country.
Well, you know, we've talked a lot about what makes a meme, and a theme that we keep coming back to is that it needs to be a brand, not needs to. It helps if it's a brand people understand. People understand Bed Bath.
Sure.
People get it.
Sure.
It's kind of like a GameStop for towels.
Sure. Oh, interesting.
I don't know.
I like it.
Maybe,
well, I mean,
right? Like, I don't know.
Well, and probably unlike GameStop, there actually is meaningful upside from remodeling the stores and making them nicer places to be. Like Bed Bath is, and they sell stuff that people need, right?
I think it was a $5 stock when he took over, maybe?
It was, run by really horrific, entrenched management. He has come in over the past 2 years, really added 7 or 8 new people on his management team, overhauled the company from top to bottom. So it'll be interesting to see where they go from here. And to your point, Miles, one theme in these meme stocks are, can the company turn around? I'm looking at Express right here. Again, I'll keep mentioning this. Tim Baxter just came out with this, said the company is turning around, likely having a good third quarter. Shares are up 17% here.
We've also talked about the different approaches that management have taken to becoming a meme or to getting this retail interest. And there's sort of 3 buckets. One, you can confront it hard, head on, welcome it, sell shares to the public, take advantage of it, and court these investors. 2, you can sort of acknowledge it, but not, and I think Tritton falls into this category. He's sort of friendly to it, but hasn't done anything directly in response. And then there's just complete denial, right? Yeah. I don't want to have anything to do with it. I don't want to say anything about it. I want to pretend it's not happening.
Because he hasn't had to do it. They have had close to $1 billion on the balance sheet, so he doesn't need cash. Express, I would argue, could use that cash.
Right. Well, as he said, they have that at-the-money offering or the shelf offering that they could deploy. The Express CEO talked about that in your discussion as well. All right, we're going to go down back to the New York Stock Exchange. Jared Blickery is there with his latest thoughts on all of this. Jared?
A great discussion. I'll just kind of continue it here. First, I want to go to the Wi-Fi Interactive, where instead of percentage returns, I actually have market cap. One of the things that stands out is I was surprised at how big some of these stocks have gotten thanks to their meme status. You look at AMC, a $20 billion stock, Nokia, $33 billion, GameStop, about $13.5 billion. That's pretty impressive. These numbers were a lot smaller 6 months ago. We're going to go back to percentage return, and I'm just going to chart some of these. We've taken a look at some of the big winners and losers. Newegg kind of stands out to me. I like this just to kind of analyze it here because it was not one of the original Reddit frenzy trades all the way back in January. I'm going to put this in a year to date. You can see it just kind of lifted off in July. And this is that typical short squeeze behavior. So Newegg, I think, is a new meme stock. It has yet to be proven, and it's coming off some important support levels or potential support levels that did not hold. So going forward, we want to see if it's going to be participating in the same way that has a similar price action to AMC and GameWorks, which is, now that the frenzy part is over, is it going to maintain its uptrend? Is it going to make higher highs and higher lows? Remains to be seen, but this is one of the more interesting stocks that I'm keeping my eye on. And then you have some of these other names, Build-A-Bear Workshops and also Bed Bath & Beyond, which we were just talking about. A lot of these stocks have simply been consolidated. And so since we're talking about this one particular stock, we could see some kind of a breakout here. Now, this can continue going sideways and consolidate for potentially a couple more weeks here, but eventually I do think we'll see that break either to the upside or downside. And then just consider that we're in earnings season right now. That adds an additional layer of dynamics. Most of these names aren't going to report for 3 to 4 weeks, being more retail-oriented names, but I was really fascinated to look at the price action around a lot of these names during the last earnings season and also for Q1. So going forward, this is a new game that's being played here.
Mm-hmm.
You know, these companies are interacting with not only their customers, but also their investors at a new level. One of the guests put something interesting together. He said, wait till these investors figure out they can vote their shares, which I think they know.
And, you know, Jared, just turning another cliche on its head, you know, the old thing is, right, you take the stairs up and the elevator down. Those charts, it's elevators up, baby, and then we're doing the stairs down, and I think that's an interesting inversion of how a lot of these stocks behave. All right, Jared Blicker, live on the floor of the New York Stock Exchange. Well, coming up next on our special, big question as the economy reopens is how consumer spending habits change. We're going to get into some of that with CEO of Lending Club, Scott Sanborn, and a lot of other things, going on with that business. Talking about all that coming up here right after this. All right, welcome back to Yahoo Finance's special presentation, Reshaping the Market. There's been a number of different phases to the meme trade, but one stock that got caught up with a quick doubling of shares back in mid-March is Lending Club. Joining us now to talk about that and a lot more going on with that business is Scott Sanborn. He's the CEO of Lending Club. Scott, thanks so much for jumping on with us this afternoon. And you've certainly heard us talking to some other of your peers in the C-suite about how they think about their stock, whether it's as currency, as a distraction, as something to really capitalize on. How have you guys kind of thought about that over the last year? I mean, if we had had this conversation July of 2020, it would have been a single-digit $5-6 stock. Today, closer to 17.
Yeah, well, look, for us, it's really a reflection, of course, of the future potential, the future cash flow of the company. And you look at the transition we've made from last summer, which is responding to COVID at a time when, of course, like many others, we had to constrict activity, to today, where we've announced the acquisition of a digital bank. And, in Q1 delivered our first full quarter results showing a real return to strong growth and an exciting outlook.
And, Scott, you've been with Lending Club since the company went public back in 2014. I believe you were COO at the time. And I'm curious, as part of that management team, how your relationship with capital markets and public market investors has changed. I mean, you look at maybe the story, I think of kind of what's happening over at Snap, right? The discipline instilled by capital markets on the company. And, as you mentioned, you guys are transforming your business maybe in response to that, maybe into forces you're seeing. And I'm curious how you think about that role, as a public company leader.
Yeah, it's been a journey, right? And it's been a journey where, we were very, very early in the space, one of the, first people to really transform lending, right? We said, hey, credit is a data problem. A technology company is well suited to solve that. And that's the market that we entered. Over time, where we are today is saying, okay, now that we've got lending, which is where the profit really comes from in banking, we're adding the digital bank services, which is transforming our model. And so we've got to get back out to the shareholders in the capital markets and explain a new story, a very different story, a transformational story of really the entire operating model of the company. So it is a journey. It's a journey that requires significant investment of my time and the time of the CFO to make sure that people understand why we're excited and so excited about the path ahead.
Yeah, and I think I think maybe we're talking around it here, or not filling in the audience. I mean, how would you kind of explain what has happened, at Lending Club over the last few years? What the model is today versus what it might have been, and how you see that evolving, for the business in the years ahead.
Yeah, so our initial model was as a marketplace, which means we took no credit risk. We sold all loans to investors. Our role was identifying customers, assessing credit risk, pricing the risk, and making the loans available to investors. What's great about that is you can scale in a way that is very capital light. And you can serve a broad range of customers, right, by matching different investor types to different loan types. Banks take the high quality loans. Asset managers take the higher yielding, riskier loans. So you can say yes to a lot of people, have very efficient marketing, and grow quickly, which is what we did. However, you are actually distributing a lot of the value you're creating into the marketplace. So with the addition of the bank, what's changing is we'll hold a portion of the loans. We'll maintain the marketplace, but instead of selling 100% of the loans, we'll sell 80. So we'll keep 20% of the loans. That 20% of loans we keep, they will earn 3 times as much for Lending Club as the loans we sell. So a significant new revenue stream and a durable revenue stream that's independent of originations. The other thing that happens in the new model is the significant fees we were paying to banking partners are now recaptured. So in our old model, we worked with issuing banks to make the loans for us. Totally, they captured pre-COVID about $30 million in revenue from our activities. We recapture that. We also used to warehouse lines to sell to big asset managers, and we would borrow money to do that. Well, now we can use deposits to do that. That was about, so the difference in those costs of borrowing money versus the cost of deposits is a 90% drop in our cost of funds. So the addition of the bank really does a lot to transform the financials. And that's not even covering kind of the strategic benefits, which is we've been helping customers with their lending. Now we can help them with their spending and savings.
And Scott, finally, before we let you go, I want to ask just how you guys see the state of the economy at this point in the recovery. Certainly, you've seen a lot of PPP money come through your system, and you've worked with a lot of customers that way. And just what the economy looks like to you as we sit here, mid-July 2021.
Yeah, I'd say we're starting to see those nascent signs of the recovery in the consumer. Like a lot of other institutions, we saw an influx of cash. Deposits really grew when we acquired the digital bank in February. They had $2.5 billion in deposits versus when we began the diligence only a year before that, it was about $1 billion below that. And consumer spending had been pretty moderate across many categories, travel, retail, fashion, those kind of categories. We are starting to see that recover. You're starting to see spending in some of those key categories begin to tick back up. You're beginning to see credit card spending as a whole tick back up. But we're certainly not back to where we were yet. And obviously, we're following the news as intensely as I'm sure you all are about what path the Delta variant's going to take and what implications that'll have for our full reopening.
Certainly something we've seen Wall Street get a little more interested in over the last couple of weeks. All right, Scott Sanborn, CEO of Lending Club. Scott, really appreciate you taking some time to talk with us this afternoon, and I hope we'll be in touch.
You bet. Thanks for having me.
All right, guys, this is meme special number 2, but this wasn't a meme special, right? Reshaping the market. And I will say, Julie, as we went through today's program, the trade, like everything else, has matured.
It has. I kind of, we've been talking lately about how it's been losing steam. I've kind of been convinced over the past couple of hours, like the lasting changes that perhaps have been wrought by this whole phenomenon.
Yeah, there's been a lot of talk that the retail investor has quieted down the past few months, but I'm going back to Express. They're out there somewhere watching this because as soon as the CEO is talking to us in real time, the stock popped 5 or 6%. So they're out there. They just need a new catalyst to come out there and buy the stock.
And another thing too is we had a number of executives on the show today, right? And some of them wanted to talk more about the stock than others. And I thank all of them for playing ball a little bit. Not a CEO's favorite thing to do, but maybe we can get the analyst community to finally talk to us. Because as the three of us know, analysts don't want to talk about this stuff, but it's not really something I don't think you can ignore when you're covering.
There's no more coverage on GameStop.
Industry. Well, right. Yeah. But their CEO is still covering it, right? And maybe one day, maybe next time their CEO will come on.
Or
Ryan
keep
Cohen.
Trying. We're going to keep trying. Yeah,
let's go.
Definitely. All right, that's it from us.
We don't bite. Cool.
Well, no, we don't bite. We'll be back here tomorrow
I don't
morning.
bite.
We're back here tomorrow morning at 9 a.m. Stick around. We've got much more Yahoo Finance coming your way live right after this.